Following another major sell-off on Wall Street, so is there opportunity in today's big drop? Our next guest runs one of the highest-rated private wealth advisory teams in the country. Let's bring in now Morgan Stanley's Chris Toomey. It's good to have you here on a miserable day in the market. You just heard the conversation we had with Professor Siegel. You want to react to anything that you heard there about where you think stocks could go?
I think it was a really good conversation. I'm upset in the sense that I think I'm going to also have to take the panel side and be a little bit more bearish than Professor Siegel. I think the concern I have is the Fed's dealing with the demand side of the equation. They're raising rates, and typically the solution for higher prices is higher prices. And the problem here is it's not affecting the supply side. And so the thing that's really turbocharged inflation is really what's going on with regards to Russia and China. China, the shutdown because of zero COVID. Russia with regards to natural resources and agriculture. And raising rates is going to have nothing to do with that. And my concern is if we have a situation where natural gas prices, oil prices continue to flow through the economy, raising rates can affect demand, but it's not going to completely stop demand. And I think that's going to continue to keep rates high and keep inflation high.
Maybe not as high, though, right? I mean,
it might start to bring it down, but I think what's interesting is you see the CPI number was very hot, but the PPI number is very hot, and it just shows how much fossil fuels are built into the overall economy. And so as great as it would be to move purely to an EV cleaner economy, I think right now we're in a situation where we're actually realizing how much that affects the overall economy.
The debate, I think, at its core, ultimately, is what is the impact on earnings if you're thinking about where stocks should be? And the prime answer is we don't know where stocks should be because we don't know what's going to happen with earnings. So you don't know what the appropriate multiple is on the price that you don't know either.
Totally.
So how bad do you think earnings need to come down? For how much is maybe better asked than the prior. Where they need to go so we can figure out the question.
I mean, I think the problem is that earnings are still projected to go higher.
Which
right?
is ridiculous. I mean, maybe they'll go higher, but not to the degree that they're still projected to go.
No, and I think we're just going to start seeing that go down and go down and go down as we go through the earnings cycle. And I think probably part of the problem is that we have these record margins. We've got higher growth expectations for earnings, and no one's ratcheting them down. So when you talk about PE ratios and you look at historical comparisons, you have to assume that earnings are going to change, they're going to come down, and then you have to reduce the multiple. And so in our mind, I think there's two parts to it. It's the macro piece that we talked about, and then the other piece of this is the liquidity piece, right? So we added all of this liquidity to get through the pandemic, and now we're removing it, right? And so take treasuries, right? For example, treasuries are the first thing to respond to these higher inflation, but we haven't necessarily really started pulling the liquidity out of the treasury market, right? So the three largest owners of treasuries right now are China, which is just coming out of zero COVID and trying to reinflate their economy. Japan, which is now 24-year low on the yen. And then the U.S. government, which in the next year is going to pull $1.5 trillion out of the treasury market. So if that happens, treasury yields have to go higher. And that's obviously going to affect the earnings risk premium because you've got higher treasury risk-free rates and earnings are going to come down.